Good Saturday morning from Chicago. This is Macro Cafe episode 21. I am your host, the Cowboy, and this is Elliott Wave Cafe. Let's get started. All right, so lots to talk about one more time, and let's see what happened into these markets. Guys, we're going to try to cover the S&P 500. Is it a fail? Is it a rally upcoming? What's going on in there? We've had a couple of volatile weeks in here, and they're definitely interesting to talk about. And then we're going to take a look at energy and commodities and see what's happening in there. The dollar, the almighty dollar, it's very, very strong. The euro is weak. Let's see if things are about to change in this field. And we're going to take a look at ARKK, the Semiconductors, SMH, and the poor old Nvidia with the latest sell-off in there. Then we're going to take a look a little bit at yields. Is there a sell-off coming? Are these yields about to actually break much higher? What's going on in there? Then let's take a look at the crypto total market cap, and then 3 charts you do not want to miss. So that's what we're going to talk about. This is my agenda for today. We'll see how long it's going to take. But before we jump on, I want you guys to check out my Twitter channel at Elliott Cafe. Go ahead and subscribe and, be part of our discussion. And there you can find me. I'm available for questions, charts, anything like that. Go ahead and give that a try. And then you can also find me on Telegram. I'm on t.me/Elliott Cafe _bot. This is one T only in the Elliott Cafe. We're going to cover there every single day, every single week, macro assets, Bitcoin and altcoins. This is a private channel, is a paid channel. You can check that. Underneath the video, there is a link that can take you there. All right, let's get started. So the S&P 500, this is a channel that starts back in 2008, 2009. This is after the global financial crisis, JFC. And, we've rallied very nicely since then, and prices have been contained in this upwards trajectory. You can see that if you connect this low with this low and then you project it, to try to touch these tops, this is kind of what you're getting. And you're also getting a middle line in this channel, which is very important. You can see how many times this middle line has been tested. And you can also see in here the percentages of the most major sell-offs ever since we've had these lows in 2009. So again, this middle trend line, it's extremely important, and we have been testing it as well in this latest sell-off. We bottom up there in around June 18th. So you can see that the first sell-off was about a 17%. Then the second one, from the highs to the lows, was roughly about 21%. This one was 15%. This one from this high to this low was about 20%. This one was a little bit bigger, right? This is the COVID one. It was a big of an outlier event in here. And it kind of, just stopped right there. I mean, actually, you didn't really have the trend line back then, but if you were to connect, let's say just the top of this channel, just simply these prices back in here and projected from this low, this would have given you the low of the COVID with pretty high accuracy. And then we've rallied nicely since then, and then we corrected 24%. So it's the biggest correction since 2009 in the S&P 500 if you're, let's say, taking off the COVID decline. Now, I wanted you to pay attention to the reaction after we have found this low. So after the 17% drop, the markets rallied, and they've created a little bit of an impulse out of there. And then what that circle is, that was the retracement, and then they've continued higher. The markets corrected, they rallied, they retraced where the little circle is, and then they've rallied higher. They've corrected, they've rallied, they've retraced a little bit where the circle is, and then we've rallied higher. Similar in here, you've corrected, you've rallied, you've corrected again where the circle is, you've rallied higher, and then it was the COVID, right? So look at this. You come down to the middle of the channel, exactly like in these other similar situations. You're climbing out of there, you're coming back and correcting, and then what is probably going to happen next? We're probably going to go back up higher. So I just wanted to show you in perspective kind of how things look and, you know, how scary some of this stuff might have looked, right? Like you're going up, you're coming down. You're like, oh my goodness, it's the beginning of a new bear market. You know, you're down 17% and the markets rally, they test some moving averages, then they come back down and then they continue to push higher. So the same narrative that's happening right now, I'm pretty sure has happened prior to all these sell-offs. You know, if you probably go back in these dates and watch the commentary or the videos or the CNBC, I'm pretty sure it's the same thing over and over again. Now, yeah, you could say that you're in a different environment now, that you have rising interest rates, that you have, you know, inflation, and this time is different and all that and the other. Sure, very true. But for right now, this chart is showing you clearly that you're testing the middle of the channel, what happens after the reaction, and kind of what's the size of this correction. Now, if for whatever reason this fails and you're pushing lower, right, you're going to come back towards the bottom of this channel, and that's likely where you're going to find resistance. So all in all, you continue to stay in a pretty secular bull market. And here you have this cyclical corrections along the way. I've been talking about this for a long time, and you just got to watch price action in here. So it's so easy, let's say, to be super bearish and to kind of think about crashes and about, you know, something that happened in 2008, something like that, right? There's this size of a correction that was like, whatever this was, 50% or 60% or whatever this was, I don't remember. But it was a pretty deep one, right? That something like this necessarily has to follow. Well, it doesn't have to, right? And you also have to think about, you know, how much leverage there was in the system back then, you know, what created all of this, and then kind of where we are today. So I think it's a little bit different, and I don't think there are structural issues with the markets in general. Yeah, the Fed is raising interest rates and they're withdrawing liquidity and all that, but, you know, would that really trigger such a big sell-off that you've had in 2008? And I think that the jury is still out on that, remains to be seen. But I have a scenario for you in case that happens, and it doesn't have to be that aggressive. But remember, I've done a video a few days ago about this, where we're looking at this as a wave 1 correction in a wave 2 that's possibly finished in a WXY. Then you rally from here, and while this move in here looks in 3 waves, you are still coming back and stopping at about this you know, advancing trend line that connects these lows from right there. So this is a little bit encouraging. We'll see what's going to happen into the next week. But if this fails and you're starting to break below 36.24, then you're probably going to end up doing something like this, where this is a WXY, then you have another X wave, and then you begin the next leg lower in a wave A, up in B, and then down in C. And this line back here, it's the trend line that I've showed you in the previous chart, is this right there. Okay, now we don't have to get all the way back there. Probably the markets, in case they sell off, they will go all the way down there. You can do a very simple A, you can do a B, and then you can do a C, and come below 36.24, be done, and continue to push higher. But let's say this is the worst case scenario, and instead of correcting, let's say, between 36 and 50%, you're correcting 61.8. 61.8 or 618 retracement of this entire advance comes in at about 3,200. That coincides with the bottom of the channel. So you're talking another 700 points of decline in the S&P 500, and this doesn't have to be a crash. It could just be a regular kind of bear market sell-off, where you're coming down in A, then you go up in B, and then you're maybe have a little sharp sell-off back in a C wave. So the reason why I don't think that you know, a major crash is coming is because of the nature of the decline from the top of the wave 1, from this top to this low, which is, you know, fairly contained, and it looks like it's a corrective pattern. So you don't have, like you've had in 2008, where I've looked at this and I've done a video on that before, where actually that first decline was very impulsive. Okay, you could see 5 waves in there, and then that was more of a clue that the markets are probably going to have a much deeper sell-off after a 3-wave setback, and that's exactly what happened. This scenario here, it's a little bit different. So, but this is what could happen in case, right, this is becoming an X wave and it was actually just a failed rally back in here. Now, how can you stay bullish out of here? Well, have you thought about this? Have you thought about WXY and a possible expanding diagonal, you know, just a leading diagonal of an expanding nature instead of a contracting nature? You got an impulse on the wave 1, you got a second wave correction, where? Into the 618, between 618 and 78.6. Then you got another rally in here, right, a 5-wave move, and that finishes wave 3. You're pulling back. Where are you pulling back? Into the 618. between the 618 and 78.6. And this could be just a sharp zigzag in here in an ABC. And then you go up in a wave 5, then you come back and correct again, and you push to the upside. The other scenario that not a lot of people talk about is that this whole thing here could be a big triangle, you know, and you can have a wave 2 somewhere lower, you know, on the larger chart. I can kind of come back and show you that. And this could be, you know, an A, B, C, D, E. And while everybody thinks that this market is going to crash or necessarily is going to rally to new highs, this whole thing just kind of moves sideways to, you know, the Fed, let's say it's kind of done and they're just pausing and then they're probably going to cut. But, you know, this is another scenario. So there's a couple of ways to look at this that don't necessarily mean that that the end of the world is coming. So I want you to keep these things in perspective and always kind of double check on what can happen if you necessarily have a very strong view about something. So this is, and I'll show you, you know, that kind of scenario. You can actually have a wave 1 in here, you know, and this is a flat in 2, and then that's a 3, that's a triangle in 4, and you can do a smaller 5th wave, and you can have an extended wave 1, 2, 3, triangle, and 4 up in 5. Maybe not that orthodox and not that common, but it's very possible. This wave 5 has to be smaller than a wave 3, and then you're getting a different correction, right? So this can always become something more of a sideways move rather than necessarily, you know, something very directional. So I presented the scenarios because I want you to think about this. And while I was waiting and I was thinking that possibly this 4th wave, it's going to stop above this wave 1 and it's going to do something like this, right? And just kind of move sideways in a little bit of a triangle. That's not what happened. The market's actually sold off quite a lot. And this is the 200-day moving average. And here you are kind of coming back into this trend line. So let's see what happens in here. Let's see what happens into the next week and if they can hold it. But I think if you're starting to crack below these levels, I think chances are that you're going to continue to push lower and begin the next decline, right? And this just becomes another 3-wave advance. So far, I still think, you know, there's something to hang on towards the bullish narrative. It's definitely, you know, not the preferred interpretation, but you're coming back here into some, you know, demand zone. So let's see what happens. Let's see what happens next week. All right, let's jump and take a look at energy. So I know energy is in the forefront and everybody's in love with it. And I see, you know, a lot of bullish commentary about this, and oil going to 200 and you know, natural gas climbing higher and things like that. But the chart, at least at this point, it just does not follow that narrative, if you ask me. I think that you know, a large part of this uptrend is starting to become in question. We were shorting DBE even after this triangle, you know, that kind of happened in here after this rally, right? And we took advantage of this first decline in here. And now what happens from here, it looks to me like a bear flag. So it does look like this is a wave of a decline. You're getting a B, and then you're probably going to get a C wave move down. Now, if you're coming back below the 200-day moving average, the whole narrative shifts and things can start to look way different. So this was the first test below the 50-day. You're going back, you're getting a little bit of a rejection, maybe moving sideways, maybe a little bit higher, but this in here, it's not very encouraging to the bull side. I just want to kind of draw attention to that. DBE is the ETF on that. Then also look at this, right? Look at the resistance levels that are coming from 2010, 2011, into 2014, 2015. You know, massive resistance in there. And this is exactly where we stopped. I mean, markets have memory, guys. There are levels that are important that markets look back at and say, you know what, we're not going to pass above that level that easily. Like, why would we, right? I mean, where are we going to take profits if you're long? Where are you going to short if you want to short? Well, that's a pretty damn good place to do it because you know exactly your risk and you're assuming, and that assumption turns into the reality, and everybody kind of does maybe the same thing in there, right? So here you are, maybe after a 5-wave advance, coming back down into what seems to be a pretty sharp move. You're correcting, and you're telling me that this is going to break higher in energy. I don't know. I'm willing to take the other side of that. Even if you might squeeze a little bit more, I just don't see this thing continuing to push before you're getting some kind of a sizable correction, and then we're going to be able to talk about that, right? I mean, right there. You know, that's not too much to ask to come if this market's correct. And if this is a 5-way sequence, you remember this thing can take, you know, quite a few years to correct before you begin, let's say, the next advance higher. So just kind of pay attention to DBC. This is just basic, simple technical analysis where you're looking at some Elliott wave structures and impulses and this kind of the strength of this move. Then you're, combining also with some trend lines and previous horizontal resistance, demand, supply, all of that stuff, and pretty big reaction in there in DBE. And look at this. This is the main trend line. This is the base trend line coming from right there. Right, just kind of following that up. Then you have a secondary trend line in here that connects this low with this low and is pushing higher. Then you had the one that's gotten super steep, which got taken out right there. Right, so now the markets are going to struggle. Maybe they're going to do a double top, but I think they're going to probably attack this next, and they're probably going to attack this next as this market comes into more of a corrective pattern. And then once you get back into these levels, then we can start thinking about possibly a return to new highs or whatever. But for right now, I think this, this sector, this energy and commodities play, it's probably a little bit in trouble. And I'm seeing still a lot of bulls out there. A lot of people very convinced that these things are gonna go to the moon, and I doubt that. Good luck on commodities. This is a DBC index, same very, very big resistance level in there. You've got the first leg of the sell-off. You kind of broke below this fourth wave low. There was a triangle, final move, down in A, up in B, down in C, or you never know. This could be a wave 1, that could be a 2, crash, 3, 4, and 5. If there is a recession coming, kiss your commodities goodbye. And they're already kind of started to pull back. You could see oil coming back down. You could see agriculture coming back down. Net gas is still up there, but I think that's coming back too. So if you're getting bullish right here after this move from all the way from, what is this, $10 all the way to $30 in DBC and commodities index, I don't know. I think you're playing with fire. So that's kind of where I'm at in this. I just remember Bitcoin charts doing the same thing. USO, triangle, final trust, good luck longing the oil market. Yeah, you're coming back into support, and it's sitting nicely right there. I haven't taken this out, which is about 71.40. So anyway, between 70 and 72, there's a big support here in USO. That's the oil ETF. It does look like, you're having a little bit of a head and shoulder in there, and you can notice the volume. The biggest volume is in the left shoulder. Then you have another kind of a big thrust and volume back there at the head, and then the volume is much lower on this side. So I don't know. I mean, you tell me. You want to be bullish here? I've seen some counts saying that this could be an A, B, and then down in C, some kind of a flat formation. I don't know. This to me does not look bullish. And, while it's possible that I'm wrong and this will, can shoot higher and just laugh in my face, I'm willing to kind of think a little bit the other way and just assume, based on this formation, that the likely scenario is that that's probably going to break and come back towards $60 in oil. And that's where we're going to have the next discussion. So watch this trend line. It's below the 20-day moving average. The 50, it's about to cross on the downside on the oil market, so you're going to have a death cross in there. Things can definitely look interesting in oil. And then you talk inflation going higher and that, I don't know. I don't think so. So that's kind of where I'm at on USO. I just want you to pay attention to very simple, no counts in here, just simple, pure, levels and technical analysis, just looking at the chart formations in here and a little bit of volume. Look at the capitulation volume here in USO. All right, gold. Gold is another market that, it's very, very interesting because there's still a lot of gold bulls out there. And listen, gold has already rallied in anticipation of inflation. All right, it started back in, let's say, if you're ignoring this consolidation period between mid-2016 to mid-2018, let's say, end of 2018, we started to rally in gold. And this was probably already in anticipation of the fact that you're going to get inflation at 9%. This market, the gold market, was already smelling that ahead of, way ahead of time. And if you look at Treasury inflation protective securities, the TIPS market, it's exactly the same thing. Those markets smelled inflation. And now, when you are already at 9% and starting to come down, what's the reason for gold to rally to new highs? I mean, I want to hear your reasons. Leave them in the comments or come on Twitter and let me know. Why would gold rally? Well, one of the reasons that it could rally a little bit is because probably dollar is going to sell off. But the dollar is very strong still. And the oil is gold is pressuring to break below these levels. Now, yeah, I do have a count, but this looks at it as a 3-wave in here, a 3-wave in here, and then a 5-wave move. And this looks like it's probably a textbook flat formation, right? And I have nothing against it. This could be a wave 1, this could be a wave 2, 3, 4, and then you're rallying higher. Fine. If that's the case, I want gold to show that to me. I want to see an impulsive move out of here. I want it to move all the way from here, 1, 2, 3, 4, 5, and start to pressure the upside impulsively, and I just don't see that happening yet, right? So when this happens, and I'm getting a little bit of a 3-wave setback, I don't know, then I'm going to jump on this and say, yes, there is a new 5th wave coming at 3, 4, and 5, and we're going to enjoy gold. But this in here, it's still very, very dangerous. Like, sure, you can have a very good risk reward in here, because you know exactly that you got to be out of this market if it drops below these levels, right? And you can say, fine, this was a wave 1, and this is a wave 2, or maybe this wave 5 is not complete yet, right? But the moment you crack below that level, in my view, you cannot be in that market, and it's so dangerously low to these levels that you got to wait for a little bit of a bounce, something to show you that this is holding, before you start to kind of embark in a bullish narrative. Look at the Newmont Mining. I mean, that stock has been cut in half, if not more than that, right? I mean, look at the GDX, look at miners. Silver actually made a new low in there. So all these commodities, just like I was showing you, they're a little bit in trouble. And if inflation continues to come down, I just don't see how gold can actually rally. Is this pricing in a drop in inflation? Is this enough? Does it need to be dropped a little bit more to really, price in inflation maybe towards 4 or 5%, or maybe even lower? Who knows? But just keep an eye on this narrative, because definitely gold is not responding in here. And it hasn't been doing anything ever since it hit this high. It did a double top back in there, and if that's the case and you're breaking this neckline, you're breaking that neckline, you can come all the way back here to 130 in gold without a problem. Okay, so that's the gold market. I just wanted to kind of draw your attention to that. Now here we are going to the dollar. My goodness, this thing, it's just nonstop. It's been so strong. It's been so strong. It's 2 years strong, right? We started, in 2021, beginning of 2021. It's exactly when the market's kind of topped and starting to sell off. The dollar has been in a non-stop rally. We looked at it corrective a couple of times. We broke above the trend lines, moving averages, and it just was a freight train from then on. And it's continuous to make new highs in here. You're looking at UUP. I don't have the DXY in here, but same thing. And we've had a couple of months ago a very nice rejection of those levels, and I was a little bit encouraged. Then you broke a little bit lower, but then the next month, which was the month of August, it acted bullish again. It did not close to new highs, but it was enough to kind of trigger a little bit more buying coming into this first few days in the month of September. So you can see that we're shooting up there. Now, it's very important what happens here. Is this market going to have enough juice to continue to push higher, or is it going to stall and create some kind of a shooting star formation, and then the next month is going to be bearish? If that happens, then it start getting really, really bullish on a lot of things. So for right now, there are signs the dollar is slowing down a little bit in there, and then the rate of ascent, the rate of change is slowing down. But it's still very, very premature to get super bullish. The only narrative that I have for you is the fact that the talk about, European Union collapsing and the energy prices going through the moon and Euro not surviving and this and that and the other, that's the type of news and the type of narrative that you have when you're getting near the lows. And I'll show you the euro dollar next year very shortly. But that's a little bit, that's not what the price is showing, right? The price is showing that the dollar is still strong. So you can do any narrative you want. There's just the psychology, and then it's the accurate price. And for right now, this is still very strong. But this sell-off in here was an early signal that this trend is probably running its course. So don't forget to continue to look at some of these candles and kind of how they react along the uptrend, and see if they're telling you something ahead of time. So that's the dollar, still above the 20, above the 50, above the 200, above the 200 week. So in a full bullish uptrend. Here's the trend line. Here's the base trend line, right? That is kind of the normal angle of ascent of the dollar. And then this is the the steepening one. And it had a little bit of a failed breakdown in here, but it pushed to new highs. And I wanted to show you that every single rally that's coming up now in the dollar, it's smaller and smaller, right? I mean, look at this one. So for me, this would have to get very, very aggressive and push higher to start to kind of destroy the fact that it's actually slowing down in the rate of ascent. So just kind of be careful. I would definitely watch this trend line and see if there's going to be any pressure towards it, and if this kind of gives way, I think the dollar is probably going to be cooked and push back lower. I heard some DeMark indicators too that they're flashing signals that this is overbought and running towards an exhaustive phase. So pay attention to that. Also look at the RSI in here. Similar story, right? It's telling you that this advance, it's running higher but at a lower rate. Now, it doesn't have to crash right away. It's not, let's say, a super strong RSI signal, but it's definitely something to watch, right? It's even if even if you're not selling dollars here, it's kind of hard to continue to get bullish based on this stuff. So people are probably going to start taking profits and think about kind of getting out of their positions. But for right now, you remain in a higher high and higher low environment, which is the definition of an uptrend. So that's what we have kind of going for us. And here is Euro at the longer time frame. This is a 1 month. The RSI, and I don't have the RSI. Maybe I have it on the next chart. No, because I know the RSI in the dollar is also very, very high from what I remember. And that's, up on the monthly charts. And that's very important as well, because you don't see that too often. So anyway, you're looking at the euro dollar in here, and you have an A triangle, B down in C for the W. I think I showed this chart a couple of weeks ago. Up in X, then down in A, up in B, and then down in C towards a big support here just below parity. Now we haven't really hit it. We're somewhere in a zone right there, and there's probably going to be good demand here, especially with the narrative that we're having right now. There might be maybe a fourth wave forming. I mean, you can see a 1 and a 2, maybe a larger third. A little bit of a fourth wave and one more push lower before this thing finishes, and then you look back to the upside. So that's kind of what I have on the euro. But again, pay attention to the narrative in there, because already the European market has been pricing in, a lot of, the European currency market has been pricing in what's happening in the continent. And, listen, I don't know. Hopefully this Russia-Ukraine war it's gonna finish up. I know nobody really knows exactly how that will resolve, right? Then you're having them they're starting to talk about shutting off the natural gas pipelines to Europe. So I'm sure there's a lot of pain in there, but just when you expect things to get the worst, I think that, that's when the shift happens. So, just kind of keep that in mind when you're looking at the euro, kind of pushing down the way it is, and how much actually might have already been priced in by the market. Okay, because, these markets are kind of forward looking. So just throwing that out there. All right. Let's take a look at ARK ETF. Now, this one, it's interesting. It's been killed, right? You're coming back again into just this kind of major band of support. This thing has been tested in 2019. What is this? Spring of 2020, right? This is the COVID low. Pushing higher here to 160 and then collapsing back again, just exactly what it started. So a bunch of this, excitement here has been corrected. The markets are sitting back at this low, and now the question is, what's going to happen now? Well, pay attention to this trend line. From here, touching this, big reaction out of there. You can see these arrows, then a push back up higher. Now the markets break below this, then you go back and retest that. So now what? Does this mean that this retest is going to give you, a break lower? It's possible, but is this really going to happen after you've already had such a big decline? With the, volume, I mean, look at the volume in here into this capitulation. That's a capitulation candle in volume. Okay, so who's actually left to sell that hasn't been sold, that hasn't been already killed by this market in ARKK? I have my doubts that that's going to happen. If you make a marginal new low, and maybe that's a fourth, this was a second, a 3, a 4, and a small fifth, I think there's a big rally coming. Okay, so big support, you already cracked above this trend line. So if you're looking at this trend line in here that connects these highs, you know, you kind of push back above it already. Now you're coming back and retesting it in there. And chances are that you can actually scream back up higher. You know, this support in here, it's massive. It's not going to give up that easily. And you're probably going to say, oh my goodness, doesn't this look like a head and shoulder? Like you have a head, you have a left shoulder, you have a right shoulder. You know, does this mean that, you know, ARK is going to go all the way back here towards $10? You know, while this is kind of fun and you know, this scenario, it's kind of very, you know, doom and gloom scenario, I don't think that's going to happen. But, you know, I can just kind of help by you know, by kind of noticing that. But even if that's the case, I think that you're still probably going to get a rally first before anything like that can happen. And listen, you got to break this first, okay? And that's probably going to be a tough nut to crack. And this capitulation in here told you clearly that, you know, that move is pretty much done. So pay attention to ARK. It's interesting. There's looks to be maybe a small leading diagonal out of there as well. If it's an ABC, you know, in an ending diagonal, then you're going to make one more low and then push higher. But I think the end of this, it's not far. So that's ARKK. Then let's take a look at semiconductors. ABC in a W, up in X, another ABC up in Y to 190. Then a pretty good rally in here, in what seems to be a 5-wave move. And this could be just a deep second wave. So, you know, don't reject this narrative automatically, even though this looks very, very deep. But that's what usually happens sometimes in wave twos. You know, you go up, and then, you know, then they're selling lower into you, making you believe that, oh my goodness, you know, you're going to new lows and things are going to crash, and, you know, I was wrong, and you know, whatever. And then you're starting to rally back up higher. So let's see what happens. Obviously, this 191, it's key. If this one gives way, you're probably moving into the next leg of the correction. Also, the RSI is pretty low. There's probably going to be a little bit of a pullback in here. Watch this line, which was resistance with support, you know, now becomes probably resistance on the way up. So I would just definitely watch. But if you're starting to climb back above this, I think there's a decent chance that you continue back up higher towards 250. So, you know, SMH in here, it's in a little bit of a pickle, but look at this. 200-week moving average in here. In blue. Support, 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 COVID support, support, big bullish candle out of there. I don't know. It's tough to get bearish right now on this thing. Yeah, this was a big reversal pattern out of there. So it's possible that maybe this thing is, you know, going to continue to push lower, but, you know, this pattern right there, you know. But don't forget, this is a big trending moving average, and usually people step in on that. What could happen is maybe you're going to get a B wave, right? And then you're probably going to get another sell-off, and that's going to be interesting. But I don't think we're going straight down in it. So as kind of crazy as that sounds, I don't know. I would just definitely be cautious back in here in terms of being super bearish in SMH. Okay, let's take a look. Let's take a look at yields, and then I have some Nvidia and stuff too. So here is the 10-year. Right, I mean, big downtrend. This is, you're talking, you know, 79, 80s, right? A lot of people weren't even born back in here. They're probably watching this video. I was born in 76, so just a little bit earlier than that. But look at this. It's just the you know, the most, you know, the largest decline in rates, you know, in history in here. Look at that. Right, and that culminated almost into going negative into the 10 years. So now we've obviously had a big rally in the 10-year yields. We're sitting right now at about 3.2%. We have cracked above, this is a monthly chart, right? We've cracked above this upper, this kind of declining trend line in here. We'll see if it's a failed move or not. It does look like it's long in the tooth. There might be a correction in here. But this is what I think is going to happen, because this does look like a big head in here. And if there is a reversal, and like say for the next, let's say 30 to 40 years, you're going to be in a, you know, rising rate environment. Maybe yes, maybe no, but you know, that means that you're going to have to create some kind of a, you know, like this was a, look at this, right? This was a head and shoulder formation right there, right? The rates have been climbing probably for a while. I don't have the charts kind of going back even lower, at least not here. But, you know, left shoulder, right shoulder. and then you're cracking below, and then it was all the way down from there. So those head and shoulders, and I'll show you charts about it at the end of the video, how important they are. This head and shoulder told you that this is done, right? And just like I was talking, I mean, there's similar stuff happening here in energy, and anyway. So I told you that the move, it's probably done, and you're coming back lower. And that took, again, 40 years of declining. Now you found a low near zero, right? Your left shoulder is in here. It's probably going to sell off here, and then maybe you're going to go back up higher. So that's kind of what I'm watching. But definitely interesting break. Here is kind of how it looks. Big resistance level in here that kind of carries over. Look at that. All right, I don't think this is right. I got to go a little bit higher. But definitely 2013, 2014, then 2018, 2019. Now here we are. Declining RSI pretty heavily in here. They're trying to tell you that they're going to break to new highs in rates. I don't know, guys. And this is a signal that the Fed is probably a little bit too aggressive, and they're probably going to slow down. This is at least what I'm seeing in here, in what the notes, what the bond market is telling me, that it tries to rally in here on a much lower RSI, still into this resistance. Sure, you're still in this kind of uptrend, but very possible that this is going to come all the way back here. Let's say over the next year or so, couple of years maybe, and then probably go back up higher. But I doubt this is going to shoot straight to the moon. Okay, so take this with a grain of salt when it comes to rates and then moving much higher in here. So that's what I got in the 10-year, man. I mean, it's it's something. So I'm definitely watching for a reversal. Okay, Nvidia. This is an arithmetic scale, so not a log scale, and I just want to kind of put this for proportion for you. And we've corrected about 61.8%. The market's held a little bit. They held at about 38%, and they held a little bit of 50. And now they're holding at about 61. Broke below that, came back towards this cluster of support, which is right there. And this is where we are. 200-week moving average is right there. Okay, which is a long-term kind of buying signal for these markets. Now, yeah, the news in here are bad, and maybe this thing is going to go back to 98, or maybe going to go back to 66. I don't know, but it's a little much, if you ask me. And I think there is some kind of a rally coming into this market. It's just been too aggressive, too fast, and it's into some important clusters and some important zones here. Let's take a look at the log scale. Long-term trend line, at the very kind of just anemic slope, right? And who knows if this is ever going to get touched, in Nvidia's lifetime, maybe never. But then we started to accelerate. Remember, we're doing a lot of different things when it comes to the chip markets versus what Nvidia was doing back then, right? It was just kind of graphic cards and things, and now it's chips and all kind of crazy stuff. So, definitely a big rally. 73 level, very important. If you're breaking 115, which where you're coming right now, you're probably going to go down to 73. But right now, you're just kind of toying with this trend line. You're breaking a little bit in there. So interesting. But it looks like you might have a kind of a 5 wave. So expect a little bit of a rally in here. Look at the difference between this chart, 200-week moving average, and this chart, right? This chart would make you believe that, all hell is kind of breaking loose in Nvidia, and you're, crashing to $45 and $20 next, And then when you're looking at this one, you're like, you know what? This is a trending 200-week moving average. We're into some important, fib levels in here, and I would just kind of be cautious here. That's kind of what I'm saying. So pay attention to this 115 level, this fourth wave. And if we're not holding this one, we're probably going to go back to 73. It's not a clear head and shoulder in here, reversal formation. I don't necessarily kind of subscribe to that. But even if you're coming, let's say back here, from there, you're probably going to get a rally higher and then maybe break lower. So, take the sell-off here with a grain of salt, because it's definitely coming into some important zones. So that's Nvidia. And then let's kind of close off with taking a look at the crypto total market cap. The same large trend line remains in progress. You're sitting above the 200 week moving average in here, right? Yeah, we're on weekly and 200 week moving average. That provides support. It's been a good place to kind of get involved in crypto anytime it was coming down into these levels. So big confluence in here, trend line, and then you have this 200 week moving average as well. So important zones. If you're breaking below this, things could start to get funky, and that could continue along with the stock market narrative of continuing to kind of correct lower in the next, let's say, decline. For right now, these levels are holding, and we just kind of keep an eye on the closing. There's not much really happened since last time I've talked about this, because cryptos were pretty stable. But here's how it looks. We were watching a couple of these support levels. We had a little bit of a channel in here that kind of got dismissed. This move, could be looked at maybe as leading. But I mean, I can't help but notice the fact that this is a big support, and then you went back and retested that and you were rejected. So if that's the case, and if you want to take shorts on this, obviously, you got to step out of the trade if you're breaking above 115 trillion in the market cap. And obviously you're in this trend line. So, it's just a matter of kind of what you want to do. If you want to, hop in longs in here, right, you got to make sure that if you're breaking below this trend line, you kind of have to get out, or at least below these levels. If you want to be short out of here, just pay attention, if this market kind of turns back. So to me, it's not, a real good trading environment just yet for cryptos. There's a lot of them that are trying to stabilize, find lows. They climb above the 50-day moving average, then they're below. They're not above their 200 yet. It's still a very kind of messy and, muddy picture in the crypto. So I'm continuing to kind of watch it with our members. I'm talking about those videos every day, about Bitcoin and the rest of them. And it's just, nothing that's necessarily too exciting at the moment, especially in the environment that we are right now. So we're going to take our clues from the S&P 500, from the equities, and see if they're able to stabilize and start to push back up higher, then I want to see the crypto market get kind of climb back above this, maybe break this red downtrend line, and then things can look a little bit better. But for now, we're kind of in a holding pattern. Now, the three charts that you got to see, the first one, maybe I've showed this before, I don't remember, but this is the Cpi Consumer Index, right? You're looking at the nominal value here, and then this is the rate of change. So you drop back down to about 850, so 848 in there, on the CPI month over month. Year over year. The next data comes in about 10 days. On the 13th, so we'll see what's going to happen there. But look what happens with the commodities. Again, I'm going back to the same discussion. So every time, CPI kind of rallies like that, you have a big climb in commodities markets. When the CPI comes down and then you have no inflation or declining, commodities markets do nothing. If anything, they actually collapse. So if I'm expecting a lower CPI, how can I expect commodities markets to go higher, right? That kind of doesn't work. And this chart here shows you that that's the case. So if the CPI comes back towards 6.5 or 6 or 5, then expect the commodities to kind of heavily correct lower, right? And this is the chart that kind of proves the correlation and the relationship between the CPI and the commodities, okay? So keep that in mind. I think it's a pretty important and big chart on there. And then I wanted to show you, to kind of close off, two charts. This is your textbook standard Elliott wave pattern. When you go up in 5 waves, 1, 2, 3, 4, and 5, then you have, you complete a sequence. Then you have another 1, 2, 3, 4, 5. You complete the other sequence. This is a bullish sequence. That's a bearish sequence, and then the sequence begins again. Obviously, this is, done by the computer, and this continues to move up and down, right? Because there's no information, no data, nothing like that. But look inside how they divide. Look at the wave 1. Look at the wave 2. Look at the wave 3. Look at the wave 4, 5. Look how you're having 5 waves inside A, 5 waves inside C, then kind of how you correct lower again, and then you start the next cycle. 1, 2, 3 waves in there, 3 waves in there, 5 waves, 5 waves. And then look how the head and shoulders form. All right, you go up, down, up for a head, come back down, up for a head in 3 waves, and then you crash lower, and that's your head and shoulders. So this is a combination, obviously, of technical patterns and Elliott wave structures. And that was the genius of Ralph Nelson Elliott, that he was able to identify kind of how these structures form, how many waves are inside, what's an impulse, what's a correction, and together with the Dow theory, kind of showed you kind of how these markets actually function. And this was, back in the 20s, 30s, and 40s. So we're still using that to this day. So I love Elliott wave. I love the structures. They don't look as perfect as these looks most of the time, right? And that's where we're putting our kind of, analytical cap on, and the kind of the art form of the Elliott wave, where we're trying to decipher, what's an impulse, what's a correction, how does it look, and kind of what's the best outcome from a certain price movement. And I'm going to close off with taking a look at the next one here, at the head and shoulder pattern. Okay, and this is again just a textbook drawing of how it looks when you're up at the high, and kind of how it looks when you're down at the lows. So if anything, in technical analysis, continue to watch these patterns. After a big massive advance, this is one of the best reversal signals out there in the technical analysis. It rarely fails, to this day. And, I would say that maybe, 80 to 90% of the time continues to work. Same from the lows, maybe a little bit more trickier at the lows, but it is definitely a big reversal pattern as well. So you're coming back down, go up, head, create a neckline, right shoulder, and then you'll rally higher. And what's important to watch in here is the RSI and usually the volume. So the RSI will do something like that. On the left shoulder here, the RSI is very high. Then on the head, it's lower. Then on the right head, it's even lower. And then you're creating this divergence. And it's a similar story on volume. You'll find out that on the left shoulder, the volume is the highest, volume is lower, and here is the lowest. And then the crash is coming. And the volume situation does not have to be similar when you're looking from the lows. So you're not going to find that. You're probably going to find, you're not necessarily going to find a climbing volume in here. The volume is probably going to come up once you break out of there. Otherwise, both of these, usually the largest volume is going to be on this side, right? And then it's kind of going sideways and small, right? Because the market is depressed, and then very slowly it's picking up. And then once you break the neckline, that's when volume comes in. So it's a little bit different than when you're looking at the tops. But I hope this was helpful, so it can help you identify them along the way and just kind of how they work. And as always, guys, listen, I'm done. I appreciate you all. This is a 45-minute video. I hope you had the patience to kind of go through it. Leave me some comments. Let's get those YouTube algorithms, pushing our content towards the top and have a lot more people watching. Thanks to all the subscribers. We're fast approaching 5,000 subscribers in there. And again, as always, I appreciate you. And leave some comments. Let me know if you agree, if you disagree. If I suck, if I'm good, if I, if you like this content or what else you want to see. And I'll see you next time. Thanks. Bye.